Every time I show retirees this data, they stop worrying about their investments. Here's why. Most people think chucking everything into the S&P 500 is diversification. It feels familiar, smart, and even safe. But in reality, it's exposing you to the very risks you're trying to avoid. Once you see how properly built retirement portfolios have actually behaved through catastrophic market events, you'll never look at safe the same way again. In this video, I'm sharing the exact portfolio data that consistently turns fear into confidence for retirement investors. Let's dive in. Let me tell you about a trend I'm seeing more and more often. A potential new client reaches out and tells me that most of their nest egg is sitting in the S&P 500. When I ask why, the answer is almost always the same. It's simple, low cost, and it's outperformed everything else for the past 20 years. Some even quote Warren Buffett, who's famous for saying an S&P 500 index fund is the best investment most people can make. And honestly, I get it. I really do. After decades of saving and investing, the last thing you want, right as you approach retirement, is to make a mistake that can put your retirement plan in jeopardy. So you cling to what feels safe, familiar, and proven. You stick with the solution that worked so well for you during your working years, the solution that successfully got you to the finish line. Because why fix something that doesn't seem broken? But here's the twist. That seemingly safe and smart choice is often driven by misinformation, overwhelm, and anxiety, not logic and evidence. I'll let you in on a little secret. One of my guilty pleasures is watching TV in bed to fall asleep. My wife especially loves it when I spend 10 minutes clicking through every app, checking out all of my options, only to end up rewatching another episode of Seinfeld for the 100th time. Behavioral experts call this the paradox of choice. When we're faced with too many options, we actually don't feel empowered. We feel overwhelmed, and we revert back to something familiar. And that's exactly what's happening with retirement investing today. You log into your account, and you're hit with 50, 100, sometimes thousands of investment options. Growth, value, small cap, large cap, international, bonds. It's exhausting. So most people freeze, and they default to the one thing they recognize, or the one that's been performing best recently, or the one they heard the greatest investor of all time recommend. And for most of this century, that's been the S&P 500. Compared to the thousands of other confusing options, it feels simple, smart, and safe. But in reality, that simple choice is exposing you to the very risks you're trying to avoid, especially in retirement when your portfolio has to consistently provide a paycheck. What many people don't realize is that proper diversification, and proper is the key word here, proper diversification can actually reduce risk and improve returns while staying simple and low cost. You don't have to choose between simple and smart. You can have both. And here's why so many people still struggle to make that shift. There's a powerful psychological force at play called familiarity bias. We naturally trust what we recognize, even when it increases our risk. It's why so many retirees mostly stick with US stocks or the S&P 500. It feels like home. But true confidence doesn't come from familiarity. It comes from understanding, and that's exactly what the data provides. And in a moment, I'll show you the data that proves it. But first, let's look at why investing most of your savings in the S&P 500 may be far riskier than most retirees realize. An S&P 500 index fund owns 500 of the largest companies in the United States. On the surface, that sounds safe and diversified, especially compared to your stock-picking neighbor. But here's the primary problem. The S&P 500 is only made up of US stocks. Meanwhile, there are over 18,000 other publicly traded companies outside of America, representing 35% of the global equity market. By concentrating everything in a single country, you're introducing a very real form of geographic risk. Now, I know what you may be thinking, but Taylor, the US stock market has been the world's top performer for decades. Why would I bet against this country? And technically, you're right. US stocks have delivered higher returns with less volatility than international markets over the last 50 plus years. But here's where that logic breaks down, especially for retirees. Investment returns are lumpy. Those attractive long-term averages you see in the headlines, they don't show up neatly every year. Sometimes US stocks skyrocket, sometimes they collapse, and sometimes they go nowhere. That inconsistency creates two big problems. Number one, investing is highly emotional. As Charlie Ellis once said, the average long-term experience in investing is never surprising, but the short-term experience is always surprising. And when your portfolio constantly surprises you, it becomes much easier to panic and make costly decisions. For retirees, those surprises aren't just stressful, they're dangerous. Panic selling and stuffing everything under the mattress or chasing the next popular investment trend can quickly derail your entire plan. Smart global diversification helps smooth out that ride and, in turn, dramatically improves your odds of staying invested for the long run. Second, when you're retired and taking regular withdrawals, your S&P-only portfolio lacks assets that zig when U.S. stocks zag. And that matters a lot because once you're drawing income from your portfolio, the order of your returns becomes just as important as the returns themselves. If your U.S. stocks drop sharply while you're in retirement and you're forced to sell shares at a loss to fund your expenses, you could permanently reduce your future spending power. That's what's known as sequence of returns risk. Global diversification helps buffer against that. In fact, here's a crazy statistic most retirees are not aware of. Since 1974, in every single year when U.S. stock returns were below 4%, international stocks outperformed by an average of 2.4%. I'll say that again so it sticks. In every single year when U.S. returns were under 4%, international markets outperformed, not just by a little, but by an average of 2.4%. That kind of diversification isn't theoretical. It's practical. It gives you something to sell when U.S. stocks are down, allowing you to fund your retirement income without locking in losses and without stress or worry. And I'm about to show you how it's helped retirement investors through two major storms by showing you the exact returns of the S&P 500 versus a properly diversified global portfolio. The first major storm to review took place in the 1970s. Since data and investment options were more limited then, for this comparison, our hypothetical diversified portfolio looked like this: 20% S&P 500, 20% small cap value, 20% international developed, and 40% in 5-year treasury bonds. So from 1970 through the end of 1979, the S&P 500 delivered a total return of about 76%, roughly 6% per year on average. Not terrible, right? On paper, maybe, but here's the problem. Inflation averaged nearly 7% per year during that same decade. So after inflation, S&P 500-only investors actually lost purchasing power. Their so-called growth portfolio didn't grow at all in real terms. Our hypothetical diversified portfolio, on the other hand, averaged about 9.5% per year. After inflation, that means globally diversified investors not only preserved their purchasing power, they grew it. Even through one of the most difficult decades for retirees, diversification turned a challenging decade into a survivable one. A few decades later, the world changed, but the lesson didn't. The early 2000s brought another storm, one every viewer remembers all too well. And this time, investors had more tools at their disposal. So instead of our simple 1970s mix, our updated diversified portfolio builds on the same foundation, but adds real estate, emerging markets, and international value stocks. So from 2000 to 2009, the S&P 500 lost about 9% in total, a negative 9% total return over 10 full years, commonly referred to as the lost decade. And it wasn't just a slow erosion. The S&P 500 actually dropped more than 50% twice in those 10 years. 2 devastating crashes in a single decade. That's the kind of volatility that can derail a retirement plan overnight. Now, if you had mixed in some bonds, say a basic 60% S&P 500, 40% bond portfolio, you would have done better. That negative 9% loss would have turned into roughly a 33% total gain. An improvement, but likely not enough to give you the ability and confidence to maintain your desired lifestyle in retirement. Here's where things get interesting. Our hypothetical global portfolio, the one with exposure to multiple asset classes and regions, returned well over 100% during that same time period. That's not a rounding error. That's the difference between barely keeping your head above water and doubling your money, i.e. your purchasing power. through one of the worst decades in market history. This is the danger of single country concentration. When, not if, but when the US hits a rough patch, your entire portfolio suffers. But with a properly built, globally diversified portfolio, you've got multiple engines driving your returns. For retirees, that means a smoother ride and consistent income, even when one part of the market is struggling. And perhaps most importantly, it means dramatically lowering the risk of running out of money in retirement. Let me explain what I mean by showing you a real-life scenario using actual data. Imagine you retired in the year 2000 with a $1 million portfolio. You start withdrawing $50,000 per year, adjusting your annual withdrawals for inflation. Pretty typical scenario for a retiree who doesn't want to die with a pile of money. If you followed this spending plan and invested your $1 million nest egg in the S&P 500, the simple, safe choice, your portfolio would have completely drained in just 16 years. If instead you built a properly diversified global portfolio, one that included small cap and value stocks, international exposure, and real estate, you would have ended that same exact time period with more money than what you started with. That's the power of smart diversification in retirement. When you're still in your working years and accumulating money, you can more easily ride out volatility and challenging times. You can ignore headlines, stay the course, and wait for recovery. But once you start taking withdrawals from your portfolio, the game changes. Every dollar you pull from a falling asset class is a dollar that can't recover later, which is why proper diversification becomes absolutely critical in retirement. It's not about trying to outsmart the market or boost returns. It's about protecting your paycheck, preserving your peace of mind, and giving you confidence to enjoy the retirement you work so hard for. When retirees finally see this data, how true diversification has performed through catastrophic events like the lost decade, their perspective completely shifts. They realize that safe isn't about owning what's familiar. It's about building a portfolio that stays strong when the world doesn't. That's the moment fear gives way to confidence because they finally understand what real resilience looks like. Still, even the strongest portfolio isn't the full story because once you retire, new variables start to appear. Taxes, income timing, healthcare costs, legacy goals. Each one has the power to undo the progress your portfolio makes if it's not coordinated. True confidence doesn't come from investments alone. It comes from connecting every piece of your financial life so that it all works together. But even after learning and understanding this, most retirees still treat their investment strategy like it's their entire plan. They invest in a diversified portfolio, hit set it and forget it, and assume they're done. Then reality sets in. Taxes start eating away at their returns. RMDs push up Medicare premiums. And that perfect portfolio doesn't feel so perfect anymore. True retirement success doesn't come from a single chart or even a perfectly diversified portfolio. It comes from connecting all the pieces of your financial life so they work together instead of against each other. That's exactly why we built the Total Retirement System, a powerful 4-step framework that connects taxes, income, legacy, and investments into one coordinated plan. And the best part is, you don't need to hire anyone to start using it. Here's a quick overview so you can take action right now. Most people want to address investments first, but we actually begin the Total Retirement System with a long-term tax analysis. And that's because just about every retirement decision ties back to taxes, from how you invest and when you claim Social Security to taking withdrawals and optimizing Medicare. Start here, and every step that follows gets stronger. The next step is designing your retirement paycheck. Start by documenting your guaranteed income sources, Social Security, pensions, rental income, or part-time work, and determine how much you'll need to draw from your portfolio every year. Then, skip the rigid 4% rule and use a retirement guardrails framework instead. Guardrails help you set flexible withdrawal boundaries that adjust with market conditions, giving you permission to spend confidently in your go-go years while protecting your future when markets stumble. Step 3 is legacy planning, and this is where you'll need to zoom out. If you plan to leave money to family or charity, build those goals into your plan before choosing your investment strategy. This is also where you'll address long-term care, estate taxes, and ensure your documents actually reflect your intentions, not just what you think they say. A coordinated estate plan ensures your hard-earned money is aligned with your values. Finally, step 4. It's now time to build your portfolio, but now it's backed by a tax-smart, income-aligned, legacy-aware plan. This removes the guesswork and helps turn investing from something stressful into something strategic. At our firm, we build and implement globally diversified portfolios, REITs, emerging markets, broad international stocks, U.S. large caps, and small cap value stocks. Not because these sound important, but because academic research has proven that they complement each other and belong in a retirement portfolio. For bonds, our goal isn't growth, it's protection and income. So we use a mix of high-quality U.S. treasuries and inflation-protected securities and ditch riskier solutions like lower-grade corporate bonds. The right mix between these asset classes helps stabilize your income, dampen volatility, and keep your long-term plan intact when markets get noisy. It also supports the research that drives the retirement guardrail strategy. For example, if you're following the guardrails-based withdrawal strategy, you have $1 million portfolio and need about $55,000 per year, the research points to an allocation of 65% global stocks, 25% bonds, and 10% cash. If you need more or less income from your portfolio, simply adjust your stock-bond mix up or down. More stocks for growth and higher withdrawals, more bonds for stability and lower withdrawals. A portfolio like this isn't about chasing returns. It's about coordination. It balances healthy growth with downside protection, inflation defense, and tax efficiency, all within a system that works in harmony. When you connect the 4 pieces, taxes, income, legacy, and investments, you stop managing your money in isolation and start managing it like a complete, evidence-based retirement plan. Now you can see why so many retirees stop worrying once they see this data. Confidence doesn't come from luck or guesswork. It comes from evidence and clarity. A properly built, globally diversified portfolio protects your income, steadies your emotions, and gives you a smoother ride through retirement. And now you know, investing is just one part of the equation. True success comes from connecting taxes, income, legacy, and investments into one coordinated system. You can absolutely build this yourself. It just takes time, discipline, and keeping up with changing tax laws and markets. If that excites you, you've got the roadmap to get started. But if you'd rather have an expert coordinate all of it so you can focus on enjoying retirement, my team and I are here to help. Click the link below to schedule your free retirement strategy session. We'll review your current situation and show you how to build an integrated, evidence-based plan that supports the life you actually want to live, with confidence instead of worry. Thanks so much for watching, and as a reminder, please review the very important disclosures for this video below in the description.